If you're taking a deeper dive into your investments, you may be wondering, what the heck is an ETF? It's a good question, and the answer can help you make informed decisions about your investments, which is how you should roll when it comes to putting your money on the line, completely informed. Thank you for watching. I am Lacey Langford, a financial coach, veteran, and mil spouse. Basically, military money is my jam. If you want to learn more about military life, money, and entrepreneurship, be sure to subscribe below. Please and thank you. Knowing what an ETF is and how they work can help you decide whether they're a good fit for your investment strategy. As with any investment, there are pros and cons to an ETF. In this video, I'm going to be going over what the heck an ETF is, how they work, and how you can use them. Plus, I'm going to go over some of their advantages and disadvantages. First up, what is an ETF? An ETF is an exchange-traded fund, which is a basket of securities that can be bought and sold on an exchange like the stock market. It's like everybody in your neighborhood chipping in money to buy an investment. Everyone who puts cash on the line owns a share of what you purchased. With ETFs, that would be of the purchase of things like stocks or other securities. So it's everybody pooling their money together. ETFs have similarities to stocks and mutual funds and are used to invest your money. Like individual stocks, you can buy and sell ETFs throughout the trading day. Also, like stocks, ETFs have a stock or a ticker symbol, which are letters that abbreviate a stock's name. You usually see them on the news. ETFs are similar to mutual funds in that they're a way for fellow investors to pool their money in a professionally managed fund. There are currently hundreds of ETFs to choose from to fit your financial needs and goals. They can contain a mixture of securities such as stocks, bonds, and other types of investments. Now, here's why you should know what an ETF is. You should know what an ETF is because if they're in alignment with your investment goals and your strategies, ETFs can be a valuable investment option. And the more options you have, the better you can have your long-term goals to be reached. ETFs are more popular investment options because they are easy to buy and sell like stocks, but offer greater diversification similar to mutual funds. But before you start putting your money in anything, you should have a basic understanding of how they work and how you want to apply them. With any investment, if you don't understand it in good times, you sure as heck aren't going to understand it when things are going wrong in bad times. Other reasons to understand ETFs is because they can offer you ease and flexibility in investing. They can reduce your investing expense and give you tax efficiency. There are different types of exchange-traded funds. Just like mutual funds and index funds, there are a boatload of ETFs out there. They come in many, many different ways. ETFs can vary in the assets that they hold and how they're managed. So for example, the different types of ETFs are based on their underlying assets. So there are bond ETFs, which are income producing bonds that trade like stocks. There's equity, which is a basket of securities that track a specific set of stocks. There's commodities, which are natural or agricultural resources like oil or wheat. And then there's currency ETFs, which are a basket of different currencies, or you could just have one like the US dollar. ETFs can be either index-based ETFs that are passively managed, or they can be actively managed. The more popular ETF type is the index-based ETF that replicates or copies an existing index like the S&P 500. Remember, you want to invest in ETFs that align with your investment goals. So how does an ETF work? How an ETF works depends on the type of ETF you invest in. In most cases, it will be an index ETF. In that case, there will take passive approach to an investment because they mimic or track an index. Indexes are portfolios that represent an economic market or a segment of the market. For example, the S&P 500 is an index made up of 500 of the largest US traded companies. An ETF that mimics the S&P 500 will have the same 500 securities in their fund. ETFs distribute money across various companies, industries, and parts of the world. This is also known as diversification and can help reduce your investment risk. ETFs gather the money from their investors to make a purchase of an investment. Remember, everybody in your neighborhood pooling their money together. When you buy ETF shares, you own portions of all the securities within that ETF. And as the value either goes up or down, so does your investment. So there's a chance to gain and there's a chance to lose, just like in any investment. So how does an ETF even start? First, a fund manager or the sponsor of the ETF who owns the underlying assets that are going to be in it. They create the fund and outline the goals and the characteristics of that ETF. The underlying assets can be things like an index, stock, or a bond. The next step is the fund provider sells the shares of the fund to investors like you and me, everybody in your neighborhood. And the third step is the ETF owners buy and sell their shares throughout the trading day. So that's the basic setup of an ETF. Now, how to invest in an ETF? You invest in ETFs through brokerage accounts. Brokerage accounts are found at any bank, financial institutions like Vanguard, Charles Schwab, Fidelity. FYI, the Thrift Savings Plan, the TSP, which is the government's version of a 401k, does not have ETFs, nor do most 401ks, but some of that is changing a bit for 401ks, but know that the TSP does not have ETFs. To begin, first look at the type of ETF that fits in line with your goals. Next, you're going to compare them to similar ETFs based on your investment objectives, the fees, risk. There's a lot to consider. And the next step is you're going to open an account with that firm that offers the ETF you want, and you're going to buy the number of shares you want. So how an ETF compares to a stock is important. ETFs and stocks both trade based on share prices throughout the day on an exchange. Beyond that, these two differ when it comes to diversification. When you invest in a stock, you only own a share of that stock or however many shares you own of that specific company. Compare this to investing in ETFs, which helps you diversify your money and reduces risk because you have a basket of stocks that you're invested in with an ETF. When it comes to ETFs versus mutual funds like ETFs pool investors' funds to purchase securities. However, unlike most ETFs, passive strategy, mutual fund managers take an active approach in most cases. This means that they select securities and trade them in an attempt to beat the market. ETFs also usually cost less than mutual funds. There are no minimums to invest in ETFs. Thus, you only need to be able to cover the cost of the investment. The management fees are usually lower, and usually they don't add a sales fee. Mutual funds generally require an initial investment of $1,000 to $3,000. And to compensate for all the active trading, they also charge higher management fees with mutual funds. So there is more of an expense when it comes to those. Lastly, ETFs offer more flexibility. They trade throughout the day and their share prices change as investors buy and sell as the market changes. This gives investors more opportunities to buy shares at a lower price or what the market price is. Mutual funds do not trade as often. Trades happen only once per day after the close of the market. The trade price is also determined at that time, which is different from being able to trade throughout the day with stocks. Okay, ETFs versus index funds. Like ETFs, index funds are investment tools that aim to mimic an index. They are collections of securities, and like ETFs, they're also passively managed. As a result, both are low-cost investment options. Where they differ is in how they trade. ETFs trade throughout the day again. Index funds trade after the close of the market like mutual funds. So that is a big difference. ETFs also have no investment minimums compared to index funds, making them easier to buy into. Now for the pros and cons of ETFs. There are pros and cons to consider when investing. So ETFs are no different than any other investment. The most significant advantage to investing in ETFs is that you can buy a mixed bag of stocks or securities in one big swoop instead of trying to get them onesie twosies to get diversification. When deciding if an ETF is a good option for you, remember your financial goals and weigh them against the pros and cons. So here are some of the pros. First one, diversification. ETFs have a diversified mix of investments. Second, they're easier to trade. They have that liquidity, more opportunities to trade throughout the day as the market sets the price. They also have a lower buy-in requirements. Compared to mutual funds, the initial investment is less with ETFs. The next pro is the simplicity. ETFs can be easier to build your own portfolio because you're getting that diversification built in. The next is low cost. Low expense ratios and management fees make investing in ETFs cost effective. And there's also tax efficiency. When held in a taxable account, an ETF is more tax efficient than a mutual fund because most ETFs follow an index and aren't actively managed, which creates fewer taxable events. Some cons. The cost. ETFs have management fees, so they are a little bit more expensive than if you were going to buy a stock directly, just buying it outright. The second con is there's a lot of options. There are a boatload of ETFs to choose from, and sometimes that can slow your decision-making process. And the last one is commission costs. Flexibility could lead to additional trading activity, which could have some additional fees and consequences for you. All right, let's wrap it up. ETFs are an investment vehicle that features significant advantages to grow your money long term. There are different types of ETFs you can invest in based on your risk tolerance and investment goals. ETFs can be used by all types of investors, but they are really a great option for new investors. Knowing what they are and how they can help you make an informed decision about incorporating ETFs in your investment strategy is important. I want to know, are you already using ETFs for your investing? Let me know in the comments below. If you want to learn more about ETFs, you can get the links for more on the topic in the description below, as well as links to find and follow me on social media. I am Lacey. Thank you so much for watching, subscribing, and for the thumbs up. I will see you in the next video.